can just start by asking you to give a brief introduction to everybody, please. If I can start by introducing Jess.
Yeah, good afternoon, everybody. My name is Jess Jackson. I'm Head of Investment at GC Angels. We are an early stage investor across a variety of sectors that are aligned with the local industrial strategy. So digital, creative and technology kind of dominate, but there are other sectors present in our portfolio as well. We've got a portfolio of 22 businesses at the moment, which do include some fintechs in sort of B2B and B2C offerings. And I will sort of touch on some of those in the questions today. I'm so delighted to be here.
Thanks very much. Andrew?
Hi Deborah, hi everyone. Thank you for your time this afternoon, great to be with you. My name is Andrew Aldridge, I'm a partner and head of marketing at Deepridge Capital. So we are a venture capital fund manager specialising in EIS investments, so early stage companies, particularly in tech and life sciences. Those are our areas of expertise. So within our portfolio of 116 companies to date, we've got a number of fintech companies across the UK and globally. So we have companies that we brought to the UK from overseas, particularly from Australia and America. So yeah, looking forward to kind of chatting a bit more about kind of a bit closer to home.
Thank you. Carrie, can I ask you to go next?
Absolutely. Hi, Deborah, and hi, everyone. Thanks for joining. I'm Carrie Babcock. I'm an investment manager at Verlingue. Verlingue is a transatlantic Series A and B investor. Our London office, I'm reaching you from London today. We also have operations in the US, so we can be quite good for European companies that are expanding into the US. We've been around for 30 years, so quite a long time. And we're sector agnostic, so we will look at a variety of different sectors and different business models. We have made some fintech investments. You may have heard of Access Pay that's in Manchester that we may be able to sort of discuss a little bit later on, but I think have been riding a nice COVID tailwind at the moment. But yeah, generally we invest about £3 to £5 million, maybe our average ticket size, into companies that are revenue generating, usually generating at least sort of a million in revenues, or at least sort of on that run rate.
Lovely. And Will?
I am an investment manager with Mercy Asset Management. We are a diverse investment asset manager with quite a big stake in venture, which is where our origins are in IP commercialization. We run a range of EIS, SEIS, VCT, and regional funds, which include the Northeast Fund, Northern Powerhouse Fund, and the Midlands Engine Fund. And then we also have a private equity and commercial debt arms. We've done a number of different fintech ones. The ones that I'm personally involved in are Incudo, which is for solutions for building societies and credit unions, and then Airship, which does a range of different gifting and plugins to EPOS systems.
Wonderful, thank you very much. And as Nicholas says, I'm Deborah Walker. I head up the financial and professional service teams at Midas. Midas is Greater Manchester's inward development agency, and we've been working in the fintech space now for a number of years, and are very, very proud of our growing and extremely successful fintech sector here in Greater Manchester. Delighted to be here. What I am not is an expert in venture finance, so do bear with me. However, Anthony has very kindly given me a very good briefing note and some questions, and so I'm going to work my way through them with you. So starting off with the inevitable COVID question, unfortunately, which I would like to be able to get through an event without a COVID question, but I think it's impossible at the moment. So what impact has COVID-19 had on your deal flow and also your existing portfolio? What's been the general feeling amongst your portfolio companies, and any sense of outlook for 2021 and beyond, which I know may require a crystal ball, but we're all hopeful that as VCs you have one of those somewhere tucked away. So if I could start perhaps with Andrew on that one, please.
Yeah, certainly. I think, obviously, COVID was a kick for all of us, should we say? And everyone's had their own struggles and their own issues. I think we obviously today we're talking specifically about fintech, but across our portfolio of tech and life sciences companies, we reacted very quickly. So back end of March, we quickly analysed our portfolio of companies and effectively RAG rated them, red, amber, green. So the green ones were those ones where we could see genuine opportunities. There were some specific opportunities you'd expect. So in our life sciences companies, obviously there would be some opportunities there, but also within fintech, we've got a couple of companies which are working on software and applications which people work remotely. So one of them particularly helping people within financial services work remotely in a compliant manner. So obviously there was a direct need for that. So for example, the onboarding process for them into a number of their key target accounts was truncated somewhat as they had to move to a remote working situation. So we had those green opportunities. We then had the yellow opportunities, which were those companies where the long-term opportunity for that company still very much existed, but it was about almost kind of hunkering down. It was just about making sure that they reduce their burn rate, etc. So now they can go back into the market. And I think majority of those August, September were very much back onto their growth curve, and the impact on them is it's probably delayed their ultimate exit by probably 6-9 months, but it hasn't actually affected their opportunity. And then of course we had our reds, which are those companies which will be directly adversely affected by COVID because they are more focused on the consumer market. That was actually less than 5% of our overall portfolio, so we were pleased with that. And actually, do you know what, in a portfolio of 116 companies, I guess probably any year you could look at the situation in macro around the world, and you'd probably say 5% of your companies are going to have some adverse reaction to what's going on in the world, whether that be COVID, whether that be Brexit, whether that be the US elections, etc. So there's always that kind of macro impact on companies. So actually, from our perspective, we were very kind of quick to get on top of it, make sure those companies were managed correctly, and make sure that the companies were taking appropriate actions to limit damage, and also where there were direct opportunities to make sure that they were exposing opportunities and really driving the business forward.
Will, can I bring you in on this question as well, please?
Yes, of course. In terms of what we were seeing, I'd say somewhat mirrors Andrew's comments. I would say overall our pipeline increased. It's been quite active. We're fortunate to have a fair bit of dry powder, so it's been an interesting time for us. Overall, I think with shifts that are caused by COVID or anything else, I think it's looking at it while it disrupts certainly some markets, it's creating a lot of opportunity. So I'd say it's really quite an exciting time to be investing.
Brilliant. And Carrie, Verlingue have got operations outside of the UK, and obviously with everything, there's just a small thing happening at the moment in the US that we're also not going to talk about today. But are you seeing any differences in your sort of experiences around the COVID piece, and any sort of predictions about what you think is going to happen going forward?
Yeah, I'm from DC and New York, but my last residence was in Pennsylvania, so I've been able to vote in Pennsylvania. So I'm like really on the edge right now. Yeah, absolutely. Well, I'll kind of just comment on everything overall. I mean, I think deal flow was a bit tough, frankly, in the spring and the summer as everything was sort of reorienting, and I mean, I was on mat leave as well, so that in the spring, so that kind of kept me out of the game for.
Oh, congratulations, though.
Yeah, I mean, I think that it's there was some firefighting and really focusing on the portfolio for quite a while. But I really, since kind of August, September, it seems like full faucets are back on. Really, some of the best companies that were kind of waiting, knowing it maybe wasn't the best time for fundraising. It really depends, how early stage the company is. If is this seed or is this even A or B? Then I think that was affecting sort of people's fundraising plans. If they were sort of fairly well capitalized, they were probably hanging back. But now it seems like in the autumn, now it's I mean, literally the first week of September, it was just like everything was back on again. So that was just a bit of a difference that I've seen in sort of tempo and velocity this year. I think with our portfolio, it was a story of the sort of the good, the bad, and the ugly, where Quite a number of companies have been riding COVID tailwinds. Access Pay is one of them. That's been really fantastic. Surprisingly, I mean, I was almost surprised, maybe I shouldn't have been, but the e-commerce plays that we're in, my first year's Papier, Mix, those have been doing quite well as everyone had to sort of shift to online shopping. I mean, we thought, well, everyone was going to be out of a job and the bad economy, but folks are still sort of spending. And then the case of the bad, I think it just hastened companies that were underperforming. It's just sort of hastened their trajectory. And the ugly is, a few companies that were doing quite well, but maybe were in the events or ticketing, space or travel space, and unfairly really have been really poorly affected. We don't in the U.S. Also sector agnostic over there. They've really built up a really fantastic health practice. I mean, we had a fantastic exit recently with Teladoc acquiring our portfolio company InTouch, which was nearly sort of a unicorn outcome for us. So that does not happen every year, and that was really exciting in the U.S. And Fintech, I think we pay a lot more attention to it in the UK side, because the UK has just been such a global powerhouse for it. So I don't know if I have anything too much to comment on sort of US fintech in particular. They are running on completely different systems over there. So, if I look at a couple of the companies we're involved in, to expand into the US, they're actually quite focused on the UK at the moment. The market is sort of large enough, they're having enough success, at least for the stage they are right now, that their opportunity right now in the UK and Europe is big enough. So a number of our companies go over to the US, but the couple of fintech ones haven't. It's not necessarily on the roadmap right now at the moment.
Yeah, no, I get that. And Jess, if I can ask you in terms of that future piece, and what are we seeing? Are we seeing lots of wonderful stuff coming down the pipe here? Are we seeing a bright future for fintech?
I mean, to just sort of touch on the portfolio side at Seed, because I think it is quite important to sort of draw those distinctions. Actually, similarly, we carried out an exercise much like Andrew described and Will in, kind of rag rating the businesses. And as Carrie said, the businesses that were perhaps on the side of performance before this happened probably just got a bit of an accelerant. But yeah, there were opportunities that were emerging, businesses overperforming as a result. So yeah, that's quite interesting. But at the seed stage, the focus of the capital that they've raised is distinctly different than perhaps where it would be on a venture capital stage. So they are generally raising money to develop their product. They've probably only ever had an MVP before. They've probably never even had a customer yet. So actually, at the point that we've invested and when we were kind of looking and doing that assessment piece in Q1 as to the impact, most businesses were kind of like, well, we're just going to carry on with our plan because we were going to be developing and we're not going to be looking to sell until Q3, Q4 perhaps. So obviously we keep an eye on it, but for the immediate, moment in time, there's no fire to put out, so we can sort of move on to the next business. In terms of kind of the businesses that maybe were at that commercialization stage, again, as Carrie said, it was kind of making the capital that they did have left in the bank last longer and be smarter with it, because it's more important to phase when you're going to be raising and also allow yourself more time at the early stage than you probably would normally, which is always a challenge for young businesses. In Q1, if there were businesses that had something ready to sell, they were knocking on doors and there was nobody there to open them, with the mass furlough in place across a lot of organizations. In Q2, when everybody was coming back, you get that door opened, to further that analogy, but there was actually real uncertainty on whether there was even just capital available to expend on things like new technologies or new products and services. And then obviously now with the quarter that we're in, or the quarter that we're approaching, it's, well, how is Brexit going to play out when actually the COVID strategy directly contradicts it? So Brexit says to stockpile, but COVID says you're going to need cash. So how those two things directly butt up against one another. So there's always a new challenge, and there always is running a business regardless of what's going on. I think it's just a shame that they've been put under a pressure cooker. I think for fintech, though, I mean, where I kind of see an interesting opportunity, and it's going to be a balance between opportunity and risk, as is literally everything. But what we're seeing is in the Greater Manchester region in particular, there are a number of companies setting up and scaling up here that are actually focused on addressing the gaps in the SME market that they feel some of the bigger players are just not looking at. So we've been talking to B North, who are applying for their banking license. It will be Bank North, but apparently you can't call yourself a bank
until you've got the license.
That wasn't a thing I learned the other week. We've got Bankify up here, and then our portfolio business Collective, Jam Today. And then there's a company called Finstant as well, who we've been working with, who are trying to help the micro SME and SME market. And I think it's such an interesting space to keep an eye on because of the kind of all of the government schemes, even if you look at CBILS and Bounce Back and who's managing those books, and everyone's getting really, really nervous about these products from like a risk perspective. But there are still businesses wanting to grow, and our pipeline is as full as it's ever been, albeit there was a complete blip in February while everybody kind of froze. So that has to be the same for lending. It has to be the same for, people still want to grow. It's just how do they actually approach that? How much time do they give themselves? And are there going to be any alternative lenders? And I think there's going to be a lot more who are kicking back against the status quo.
No, that's really, really interesting. I suppose taking all that into and shaping it into one narrative, really, with everything that's happening in terms of the whole sort of US landscape, what's happening with COVID, what's happening with EU, what's happening with potential recessions. So have there been any changes in your approaches when you're looking at potential investments?
Was that to me? Sorry.
Yes, you're on the stage already. I would kick the answer off.
Okay, fair enough. Gosh, yeah, it is really difficult, and I think because we are sector agnostic, we have to look at each opportunity under its own merit. And yeah, you do have to kind of think, well, how is this going to come into play? But again, because we're investing at the youngest stage of the business's life cycle, it's really about market size, strength of founding team, problem solution fit, and then what's going to be the thing that's going to hit them first, and how are they maybe thinking about it? But I think at that earliest point is, do we think that you can actually build the thing that you've said you want to build? And, is there a market there for it before we start to think about all of the different economic knobs, dials and levers that could be applied to them at any given point? And, as I said before, running a startup isn't heading for a peak on a mountain. It's being on the surface of the ocean, and you've got to be able to handle the different waves and the different heights of waves that might come at you in the future.
Brilliant. I suppose if I can bring Carrie in on that with a similar question, because obviously you're seeing organisations at a different stage in the life cycle. So.
Well, it was one of the first questions I asked my team because I was out March, April, and May. So just at the start of the pandemic, or that sort of that first peak. And when I came back the 1st of June, I said, well, how are we evaluating, right? How is this changing? And I think it's kind of boiled down to, if we want companies that we're already showing, because we're at A and B, these companies are already sort of $1 million, $2 million, $3 million, $4 million, a few million in revenues, and that were they doing? How was their growth trajectory pre-COVID? And then are they still? We can maybe give them a little bit of an excuse, but actually not much of one for that growth trajectory, even in this year too, because we're looking at companies, we're trying to be smart and educated about the sort of trends that are benefiting right now. I think I'm quite interested in, like, there's been a lot of sort of investment into income smoothing on the consumer side, but on the other side, maybe trade finance, and from more of the sort of B2B perspective, privacy and governance, I think is still huge. Cloud migration, sort of moving away from on-prem payments, obviously sort of in touch payments or e-commerce payment gateways, all of that. So it's absolutely affecting sort of my preference for sectors right now. And I think I'm unfortunately not, there's a couple of propositions on my desk right now, and it's, maybe this one has 26% growth at the moment. And I'm thinking, I don't know if I can really quite give COVID as the excuse for sort of lower growth, because if it's mission critical, it's mission critical. And we've seen enough really good propositions that haven't had their sales slow down too much during COVID. So we're going to be, so I think maybe that's unfair, but that has shaped my outlook, and we're still being quite strict, I suppose. I'm really looking for really, still very strong growth, even in this challenging environment.
Mm. And if I could sort of bring Will in on that as well, Will, because obviously, it's going to be a bit of a double-edged sword as well, because there's going to be winners and losers as part of this climate. So presumably you're going to be seeing firms that, that are growing because of the rising sort of e-commerce, online payment platforms, needing that sort of gap finance and staggered finance solutions. So are you changing the way you're thinking about these businesses and these investments?
Yeah, I mean, the game, the environment has certainly changed, and you have to change with it. So yes, there are absolutely some clear winners and clear sectors that, that have new opportunities because COVID is changing the way, different, just culturally, societally, the way that we operate. And that's provided a lot of opportunity to do things using technology where maybe we kind of weren't ready to let go of the in-person interaction. But I would say equally, where there are sectors that are, suffering more so than others, I think there is opportunity as well. So I would say, things like hospitality. Now, we never were ones that were going to be investing in restaurant chains, but I think the way that ultimately hospitality, the way that it operates is going to shift fundamentally. So to me, I think, there's probably a lot of really attractive solutions that'll be coming to the fore, the picks and shovels of that industry that are going to help support the way that they reemerge. And so I think there's a huge greenfield opportunity in that sector, for example. So I think, there's definitely aspects of, sort of the dead obvious, but I think there's a lot and sort of, that maybe you would think is not attractive, but in my mind actually is.
Yeah, and it's pushing that adoption curve, isn't it, on some of the consumer stuff that I know we're seeing in the Manchester market. Andrew, what are you seeing? What's the?
Yeah, I think we are very much IP driven in terms of what we invest in. So they are by their nature kind of disruptive businesses, whether that be tech, life sciences, fintech specifically, etc. So what we tend to find is those companies still they are there to solve a specific issue. So that issue hasn't gone away because of COVID. That is, that long-term objective. And, let's not forget that all what we're talking about here today is kind of the essence of what patient capital is. These aren't, probably none of us on this panel today would say that, we would expect to see returns in a matter of weeks or months. These are several year plays, etc. So from that nature, the long-term objectives of these companies is still very much there. The solution for the problem is still there. The problem is still there. For some of them, it's about timing. So, for example, not necessarily fintech specific, but one of our companies is in AI around recruitment software, etc. Now, as you've seen markets coming back, they are globally based. So in the States, they've got a great presence. In Australia and Southeast Asia, they've got a great presence. And as you're kind of seeing, particularly using Australia as an example, Australia is now coming out of the COVID situation because it's going into the summer, a bit like we did back in May, June time. Numbers are dropping and the feel-good factor. So companies are recruiting again. So therefore, it's about making sure those companies are well capitalized and have the resources they need now to be able to take advantage of the opportunities they come back. And I think, as Will touched on, we don't necessarily invest in anything directly in the hospitality sector, but some of our companies do have an affiliation with that. And actually, as the hospitality sector in the UK or wherever it might be starts to come back, as we'd probably expect, hopefully kind of, potentially Q2 next year, what have you, going forward, then it's making sure those companies are then well capitalized at that point to kind of take advantage of the opportunities. So I think it's more about timing more than anything, particularly in the kind of disruptive kind of areas that we work in. We're not, we don't invest in kind of, consumer plays, etc. These are IP driven solutions. So from that aspect, the long-term issue is still there, the long-term solution's been proven. It's about the timing, about when those companies can now really kind of crack on with their growth curve.
So it's not the gap in the market that's gone away, it's the market that's available in the gap at the current time because of everything.
Yeah, that's nicely put.
Okay. So while I've got you on the stage, Andrew, and also Will, both Deepbridge and Mercer offer the enterprise investment schemes and the seed enterprise investment schemes. Can you just confirm what this means from a potential investment point of view? What criteria needs to be in place? If you can just sort of talk through some of those products that might not be familiar to our audience.
Yeah, shall I start, Will? Shall I? And then I'll lead on to you.
Yeah, please. I actually don't focus as much on EIS.
Oh, sorry. I apologise for throwing you under the bus then, Will.
No, not at all. We have an EIS fund and an SEIS fund. It's just not my daily focus. So I'll leave you to
I've made a rod for my own back there, haven't I? Hey ho. So yeah, I think essentially, and I know Jess and GC Angel etc. work with SEIS and EIS companies, and we've co-funded on companies etc. like Jam today that Jess mentioned, etc. in the fintech space. So the key thing now for SEIS and EIS investments and investors is that money's got to be going into capital at risk companies. So these are growth focused companies. EIS has been around for 26, 27 years now. It's great in terms of the tax relief available to private investors, whether they be angels or coming by a fund that's advised, which is where we get 90% of our business from. But historically, there was a lot of things going into renewable energy, had a lot of kind of what IFAs would describe as low risk EIS, which is a misnomer in itself and oxymoron entirely. These are unquoted illiquid stocks, so nobody should be treating them as low risk. But what government did back in 2017 was they conducted the patient capital review and effectively reset EIS. They gave it a massive rubber stamp and said EIS is working. EIS is putting capital into early stage companies that otherwise wouldn't be there. It's creating jobs, it's creating innovation, it's creating tax revenues. So the government, HMRC, gave it a massive tick. This is not something which is a fly-by-night scheme that is going to go away. EIS and SEIS is here for the long term. But it is now very much focused on businesses which are seeking to grow. And I think that's the key thing. I could go into the individual criteria, but I would be boring everyone's senses. The key thing is that these companies are there. They are growth focused companies. So, it's not investing in shops that, they've got a 20-year plan to kind of keep doing what they're doing, etc., or accountancy practices or things like that. These are, really trying to put money into growth focused business where you can create jobs and create tax revenues effectively.
Jess, can I bring you in on that conversation? Because obviously you're seeing it from the seed perspective as well. You're on mute, Jess.
Sorry about that. So we don't manage EIS or SEIS funds. But invariably the majority of the businesses that we work with are SEIS or EIS eligible. So that will mean that they sort of come to us and they've got that assurance in place with HMRC. It's not absolutely mandatory, but I think we would heavily suggest it just because of the tax relief that a lot of the angel investors that we co-invest with from our public fund will require it. So, we'll actively seek opportunities within their expertise that just so happens to have those tax relief options available. So I think they just act as a mitigant, a risk mitigating tool for angels. And we would strongly suggest all kind of early stage businesses to explore them.
And in terms of those tax reliefs, are there any dangers that those could be withdrawn or be part of a tax cut exercise in the future?
I'd be very surprised.
I think ultimately, Deborah, I think the EIS and SEI structures are there. Like I said, these are things which government have rubber stamped, within kind of our recent times. There's no inclination. Even last year, as we were leading up to a general election and people were talking about, what if the outcome was different? And even then, I spoke quite a lot with some of the Labour backbenchers who were in their business strategy teams, etc. And it was recognised the value of these kind of structures. Like I said, they are net positive to HMRC. HMRC makes a hell of a lot more money out of the revenues they generate from the company's success than they do from actually giving the tax reliefs in the first place. So from that perspective, yeah, we've got no kind of concerns that there's any kind of short-term issue. And if anything, government is looking at how they can use these kind of schemes to get more cash into early stage companies.
No, that's great to know. I was just gonna say, Jess, as well. One of the things that I know was sort of come across my radar is you've just recently launched the Fund Her North. Was it on the 14th of October?
Yeah.
Can you just give us some information around Fund Her North and what prompted this? Do you think there's a real shortage of funding for female entrepreneurs and female-led fintechs?
Yeah, absolutely. I think there's no kind of secret to be made of that. And I think, the last few years there's been annual, if not quarterly reports. And I'm really pleased, actually, that most reports that are produced quarterly from, industry leads on this, like Bohurst, Tech Nation, British Business Bank, UK Business Angel Association, all now have a gender focus within their data, which is hugely welcome. And we also are championing the need for more BAME-focused data as well. So Fund Her North is actually a collective of, I think, about 28 different funding entities, of which Mercia and Deepbridge are definitely included. I'm not sure if Verlingue were, but we would love to have you, of course, Carrie. And the aim for that was really to represent women raising at kind of all stages of a business's life cycle. So recognising some of the things that came out in the Rose review, Alison Rose from, is it NatWest, which was around kind of the underdeveloped nature or even absence of women's networks, how kind of the VC industry functions, which is largely on, warm referrals, which makes sense, but actively disadvantage certain groups of the community. So we wanted to try and come together to combat that. So acting as advocates, acting as mentors, and acting as those warm intros, showcasing women who are doing their first raises, but also creating those inter-peer and sort of extra peer networks of, here are women who are raising at your stage, share best practices, support one another, but also, here are women who've raised Series A, here are some women who have exited, and also pulling in things like non-exec director networks and business support and investment readiness support for all of those kind of stages, right through to sort of Series A, even MBO and exit. So we actually held a sort of seed stage, if you will, pitch event last week, which had 6 female-founded businesses pitching for investment. Incredibly successful, really, really positive feedback about the really high quality of the pitches. I mean, we're obviously not surprised, but that was the case, so that was great. And we actually have an event coming up in due course, which is more focused on the VC side and the VC landscape. So I'm incredibly excited about what we're going to be achieving as a collective, because it is about collaboration, and it does have, obviously, the clues in the name. It's got a northern focus because we recognise, although there's all these fantastic things coming out, Manchester being the second city, overtaking Cambridge yesterday, there's still gaps, and unfortunately that is affects women and BAME founders more.
No, that's great. It's great to see that you're doing something to try and close that gap. I'm just conscious of time, so I just want to move on a little bit. And I know one of my great not mentors, but one of the great guys in finance, Warren Buffett, actually said it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And I suppose as we're heading towards Thanksgiving and Christmas, I wanted to talk about some of the turkeys. So there's been lots of high-profile companies over recent years that have raised money, and maybe a little bit less of an eye to profitability and sustainability. Do you, panel, think that the scale at all costs and then worry about monetizing is a fad? But or how do you think that's that rush to be the investor is affecting some of those less than robust investments? Carrie, can I go to you first, please?
Yeah, absolutely. This is something that we have thought of a lot at Verlingue, because we have a bit more of a focus, and our preference sort of in our DNA is to look for companies that are on a sort of self-sustaining, path to profitability that is sort of the ideal investment for us. And we were hoping that COVID might bring, sorry, I don't know, my light is like, is that at the moment. We were hoping COVID would sort of bring things a bit down to reality. We thought with the sort of SoftBank and WeWork implosion and then COVID hitting, we really thought that the sort of pendulum would start to swing back towards a little bit more sanity. But frankly, the question is this a fad? No, we have seen no effect on prices. We have only seen them go up and up and up. And unfortunately too for us. And I think that is just a systemic case in the market right now where the only sort of all capital is sort of pooling towards tech, which is like the only chance of growth at the moment. So that's why prices just have not unfortunately come down whatsoever that we've seen. I think again there is a bit of a difference at stage. So seed stage, I think, where companies have a little less proof points, if not quite hit, product market fit yet. They don't have really a leg to stand on as much. Then investors sort of will have, I think, a lot more influence on what their willingness to pay is in terms of coming in at price. But at the A and B level, it's just as competitive and even more pricey than before.
Okay, Will, can I bring you in on that question, please?
Yeah, I would say my observations certainly reflect what Carrie said. I think the good assets it's increasingly competitive, and so they're able to command that higher price. And those that are showing strong growth or exceptional growth, the pricing's intense. For us though, we've got a range of funds, so we're kind of seeing a good mix of things. Whereas I work on the Northern Powerhouse Fund, and so that's sort of a little bit earlier in stage. And I would say there still is, we're absolutely very focused on making sure that the deal works for the fund. So I would say pricing from our perspective, if the risk level is still very high, then pricing is still going to be I think at or potentially a little bit lower than it was previously. But yeah, I would say, but where you do have some attraction, then you might be able to generate some competition.
Okay, thank you very much. Well, we've got about a minute for each panelist now, just to maybe give some hints, tips and guidance to some of our fintechs that are listening today on what do they need to do right in order to attract that VC investment. Will, do you want to start since you're already on the floor?
In terms of attracting VC investment, I'd say, yeah, the number one thing you can do is win work and win show growth. That I don't think anything's changed there with that respect. I think the other thing too is just being really clear on your milestones. I suppose I realize I'm sort of just repeating the fundamentals, but I don't think anything's really changed there. But with regards to COVID, I think being clear on what is and isn't related to it. So don't just try and dress up everything that's changed as being COVID related. Sort of be specific in terms of what opportunities have led to growth. Do you think those will be sustained or not? And just really be honest about it, because we're going to be wanting to have an honest conversation. So this, don't try and sugarcoat it. We're out there in the market having these conversations every day. So it's better to just sort of be upfront and be direct and try and isolate and be specific wherever possible.
Jess, could I bring you in on that? Some top tips?
Yeah, absolutely. I think
also some things that they need to be aware of as well, some risks, if you could, for me. Ooh, Jess.
Okay. Oh, you chucked in a
curveball then. Yeah, sorry.
No, it's all right, because I think my second point sort of alludes to that. So whew, I'm off the hook there. I think I would echo what Will has said. I think, a lot of the fundamentals will still always apply. And I think as annoying as it might feel, it's still important, to show you've got that really strong product market fit and that you've got the traction to kind of get the bite of interest, if you will. I think the thing to be aware of, and I suppose the risk and the tip that I would give for that, is to just allow some more, especially at the early stage, allow more time for your raise. And be kind of patient and bring people along, and wherever you can, try and think about or ask directly. I think it's really important to ask, if you get the sense that an investor, whether they be an individual or a fund, seems quite hesitant, just say, can you please give me some feedback about where perhaps what could I do to give you comfort? And invariably that might be, we need you to bring us a lead investor who knows your sector. We might want to see your board strengthened. We might want you to sort out your cap table, whatever those things are, just ask directly, what could we do to maybe move things forward with you and get you comfortable? And it might be something that surprises you, or actually it might not be, and be prepared to listen to that, I think I would say.
Lovely. Carrie, could I ask you to come in on a similar and same question really, and just sort of give those top tips and maybe talk a little bit about some of the risks involved?
Yeah, I would never, like with Will saying the fundamentals, I just always think the fundamentals are worth repeating. So again, it's just, we are all about the numbers. It is about your growth and your sales. So just sales. You've got to figure out your sales machine, and whether you're in the consumer space, and you've got to be a really excellent marketer and know how to sort of profitably and efficiently run that machine. If it's sales and enterprise, which we didn't spend too much time talking about, that's also really tricky. And sales cycles are incredibly long, and there's a lot of sort of specificity and I think knowledge that you need to be able to bring in-house to really do that effectively. So your story, how you communicate, the research that you do, because we're all different. It's amazing how the diversity in the early stage investing world, how different firms organize themselves, what their sort of personality is like, what ticks the boxes for the partners on the investment committee. It's actually really huge. So doing your research to get in front of the right audience, and you will be told no a million times, and it's a slog. I mean, it's not that fun really. It may help you. It's like an intellectual exercise that'll help you, refine how you're thinking about approaching your business. And you may sort of come away with some good insights, I think, through the process, and then hopefully some good long-term capital partners. So that's just in the sort of basic space, I guess, to watch out for at seed, because actually I was doing seed investing before, previously a couple of years ago. I always said, I think Jess alluded to this, Jessica, I always used to tell founders, however long you think it's going to take you to raise, double it. It's just, again, a really big slog. And then I think now at the sort of, again, slightly later stage investing, you always want to choose your investors. I think it's been really interesting from Verlingue's perspective that we've been around for so long. So we can be great to help you navigate, because we've seen so many different companies go through so many different problems over the years. And what I was going to say in terms of watching out for is, I do think that even though we're patient, we are also patient capital as sort of VCT. Our funds are evergreen, so we don't have a specific 5 to 7 year time horizon we need to return our capital in. There's still, I think there's still a sort of set time period for being able to really take off before your tech sort of becomes obsolete, before new players kind of come in. And I don't think it lasts much longer than a decade. You don't have forever to get this done. Acquirers may be interested. We've seen, cases right now, we've gone through different sales processes. Acquirers were interested 2 years ago. Now they're not anymore, and you've kind of lost that opportunity. So I think that's something I actually don't know how mature the companies on the call are at the moment, but if you're getting to that slightly later stage, you really don't have forever, unless you're Jeff Bezos, which maybe you want continuously innovating your product to stay relevant and stay just stay relevant to the market is really important to watch out for.
So carpe diem. Andrew, have you got any last final thoughts? We're in the last few seconds. I'm conscious that people are going to disappear off.
I will run through this very quickly. So
I apologise.
No problem. First and foremost, I think as Jess touched on earlier, I think if you are seed or kind of initial scale up funding, get your SEIS or ES advance assurance from HMRC. Speak to the likes of ourselves or Mercia or GC Angel, etc. if you need help with that process. but that, that will open a door to funding opportunities. There's over 40 odd EIS and SEI funds in the market now. So that's something you can go at. You've got all the angel networks that will want that as well. So that would be first and foremost. I think second, they touched on it being realistic. When you're doing your fund, your forecasts, etc., be realistic. It's not Dragon's Den. This isn't TV. It's not for headlines. This is for, we are sensible, rational people as funders. We want to see realistic. We'll see through hyperbole. I think two other things very quickly. One is don't be afraid to ask for assistance. Know your own kind of limits, if you like. If you are, what we see some of the best combinations, particularly around academics. If academics are coming into a new market, is actually finding somebody who's got commercial experience to partner with them. So you've got if you like, the brains and the strategist alongside each other. That is a perfect combination. So bring people around you, and simply bring in NEDs, etc., to support your board. So obviously, we as funders will want experience. We want to know why are you the people to take this product forward. Most ideas probably aren't that unique. It's about why is the team unique, and why are they the people to take something forward. And I think that's pretty much it. I think it's why is it you. Don't be afraid to ask for assistance, and don't limit yourself. So make sure you've got that EIS and SES advance assurance.
That's brilliant. Thank you so much. And I apologise to everybody that we've run over slightly. I particularly apologise to Nicola because I promised I wouldn't do that. So thank you so much to the panel. I've really, really enjoyed that. I hope everybody listening has learned something. It's been great to be with you here today. I'll hand you back over to Nicola.
Thanks, Deborah, and I'd like to echo that. Thank you so much to you and to Mark for expertly hosting the panels. Thanks to all of our panelists for all of your insights. It really has been a really interesting couple of sessions. I'd also like to say thanks to Dave, Piers and Julian for hosting the networking lunch that I know you all took part in. Finally, thanks to OpenMoney again for all of their support. And last but not least, thanks to everyone for watching. We hope you have a good rest of the day, and we look forward to seeing you at another webinar soon. Thanks, everyone.
Thank you. Bye.